in the microns and the snowflakes, and you think what as you watch this market?
Well, I think it was a great conversation with Liz, but one thing to keep in mind is now that Q1 earnings is behind us, people thought S&P earnings would be $70. It's going to come in at $80, so that's a $10 beat. That's $40 annualized. That means that this added, the upside to earnings is somewhere between 800 and 1,000 points of S&P upside. I think the entire rally since April could be explained by just the Q1 earnings beat.
You're calling for a three-phase market still. Explain to our viewers again what that means.
Yes, our base case for this year, which we expect it to be a challenging year, and it feels like it, is we'd rally towards 7,300 initially. Now we're above that. But
yeah,
I think,
almost 76.
Yeah, and I think we can get to maybe 77, as high as 77. But I think then we're going to digest a lot of things until October, and that's a new Fed chair. It's the energy shock that Liz talked about, especially shortages of petroleum products and lubricants. AutoNation talked about it. And the third is the IPOs of SpaceX, OpenAI, and Anthropic, that when the unlocks happen, that's a lot of extra supply. So I think that could pressure stocks in a way that feels like a bear market. But then post-midterms, I think we rally strongly, and 2027 is a year where we might see some of the best returns we've ever seen in our lifetime.
All right, Brian. So you had the benefit of listening to Liz Ann and now Tom's answer. How does it match up with what you're thinking?
It doesn't differ that much, because when we came out with our year ahead piece for 2026, we explained to investors that the market environment in 2026, Scott, was going to be very different than the last 2 years or 3 years of the bull, meaning it was going to be an earnings-driven market. Earnings-driven markets are much more volatile than momentum-driven markets, what Tom's done an amazing job talking about. But they also reward
a price discovery. I would argue that even in SpaceX, we see the chart of SpaceX up on the screen right now. Even in SpaceX, you haven't really seen price discovery because you've only got about 4.3%, well, 4.9% if you include the green shoe, of the shares are even out there yet. So the demand has been so strong, both from people who are interested in the stock, people who think that this is a good company, or if they just think it's a lousy company, the stock's going to go up. Well, I don't know why people buy these things. Or the indices required to buy them means that there are buyers when there aren't sellers yet. But that's going to change, and it's going to change pretty quick for SpaceX because lockups are happening, unlocks are happening very soon.
And Corey, I'm glad you mentioned the float size there, because we've talked about this together on my other show on Market on Close, but I want to take a look at it here, and specifically about SpaceX and what they did different there with their float size and how that could then affect Anthropic and then potentially OpenAI down the line here. I mean, take me through your observations on what they did and if you think it was effective, and now then we're going to see it as a part of other playbooks.
Well, I'm glad you put it that way, because effective is in the eye of the beholder, right? What's good for SpaceX, what's good for trillionaire Elon Musk might not be good for the rest of us. It might be. But I think you've got to decide about where you sit and what the purpose of an IPO is. If the purpose is to put a company out there and allow the public to buy shares into it, allow professional investors to buy into it, compel the company to sell shares of a big company. There used to be rules that said that if you had a certain number of shareholders, you had to sell to the public or limit the number of shareholders in a company. So what we see with SpaceX is this deal was manufactured to go up, and it worked. It was manufactured to put just a little bit of shares out there to create a lot of demand. They did a lot of promotion around this thing. I've never seen so much promotion for an IPO in all my years of studying these things and seeing what companies do. You saw interviews with executives, you saw road shows, you saw tweets from the executive and the CEO from this business during the quiet period. These things never would have happened when Google went public, for example, but you saw it with SpaceX. And so what you saw was limited float, a concerted effort to increase demand, and then, as we've been talking about, the indices required to buy these things. So the limited float was very much designed to get the price up and to keep the price up. And then the company went out and borrowed $25 billion. I would argue not on the basis of the success of the business. I mean, it's a money-losing business growing at 15% on a year-over-year basis, and there's some hopeful things going on in the business, and there's some horrible things like the collapse of what used to be Twitter happening within the SpaceX business. So the bond raise, I think, was on the heels of the successful equity raise, which was on the heels of the limited float to drive the stock up. So you put a little stock out, you create the demand to drive the stock up. then you borrow money based on that success. And so they've got $25 billion in the bank, or the ability to pay down some debt, most of that debt acquired from buying Twitter. So it was a really creative effort with the IPO and structured financing at the company. I don't know what that says for investors' decisions as to whether they want to own this stock and the quality of SpaceX. But that's a different question that individual investors have to figure the answer to.
So I want to stay on this discussion about whether or not it's effective, and that's sort of in the eye of the beholder, right? So as Anthropic is looking at SpaceX's IPO, as it's the closest foil to take a look at here in terms of the potential size, do you think Anthropic, if you're Anthropic and you're looking at it, do they view that low float offering to increase or manufacture demand, as you said, as effective? And do you foresee them using a similar strategy, or do you expect them to go off of a more traditional IPO playbook?
You know, it's really hard to figure. Anthropic does things differently, and they look at the world in a different way. And so I wonder if they're going to use the tools. What we've seen here.
Wall Street may be looking at AI completely the wrong way. Everyone keep asking, has the AI boom is peaked? But the companies actually building AI infrastructure are asking a different question. How do we produce enough chips? Memory manufacturers can't build fast enough. Nvidia continue sipping the average GPU it can make. Hyperscaler keep increasing AI spending, and some analysts now believe this investment cycle could continue for the rest of the decades. So today, let's separate fear from the facts and understand why this AI story may be still be in the early chapter. The recent pullback scared many investors. Memory stock dropped and AI hardware sold off. Headlines suddenly talked about the slowing demand and competition overbuilding peak AI. But if you ignore the stock prices and focus only on a company fundamentals, the pictures look very different. Order continue growing and factories remain sold out. Customers are still signing multi-year agreements. That is really not what's happened when an industry is approaching its peak. A few years ago, GPUs were the biggest limitation. Today, the bottleneck has shifted. Now it's memory. Every advanced AI models require enormous amount of high bandwidth memory to train and generate the responses. Without enough memory, even the fastest GPUs become less effective. That's why demand isn't just growing, it's multiplying. For the decades, investors viewed Micron as the classic boom and bust business. Strong profit followed by the oversupply, followed by the collapsing prices, the cycle repeated over and over. AI may be retained that story. Instead of competing on volume, Micron is now competing on scarcity. Instead of selling to whoever needs the memory this quarter, customers are locking in the supply years ahead. That's give the company something it's rarely had before: visibility. And Wall Street value the visibility. Some people assume higher prices will quickly solve the shortage. Unfortunately, semiconductors don't work that way. You can't build an advanced memory fab in the 6 months. Construction take years. Equipment take time to install. Manufacturing yield improve gradually. Even after the building is complete, the production ramps slowly. Demand, whoever, doesn't wait. While investors debate competition, Nvidia keep expanding its ecosystem. The company isn't only selling the GPUs anymore. It's building networking, software, inference platform, developer tools, cloud partnership, and now even new financing model that help AI cloud providers to deploy more Nvidia hardware. That's how ecosystem becomes stronger over the time. Google has TPUs, Amazon has Trainium, and Meta continue investing in custom silicon. Does that threaten the Nvidia? Maybe someday. But today, most companies still rely on Nvidia for their most demanding AI workload. Custom chips solve this specific problem. Nvidia provides a complete platform that makes a difference.